Hi, and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Hi, and welcome to the podcast. It's the 11th of May, 2023. My name's Brendan Campbell. I'm here with Charles Yuan. We're going to talk to you about the budget, Australian federal budget. Tuesday night, budget was handed down. Look at it a bit from a tax point of view, and I guess some of the things from a business point of view. It's a bit of a lackluster budget, but let's have a chat about it. Charles, how are you?
Good, thanks, Brendan. Yeah, another budget come around and another lackluster budget, unfortunately.
It is. And I guess they're a bit to be expected these days. They sort of leak a little bit beforehand. You find a bit more about it. There's not always too many surprises coming out, it seems, in the budgets these days, not like days of the past. But I guess positive news, there's a surplus coming.
Yeah, apparently it's being forecasted the next year will be $4 billion in surplus, which is the first time in 15 years, as the news media reports it.
Well, as you said, budgeted though. So budgeted forecast next year, and then deficits the year after. Is that right? That's the way they're pitching it?
So according to the government, due to the strong commodity prices and high income tax collections, there's a temporary uplift in revenue. So $4 billion surplus for the next year, and going back down to a small deficit thereafter. So yeah, not the best, but it's still a surplus.
It's still a surplus,
yeah, helps.
And at least with this predicted surplus, it's not like it's been in the past where it's a deficit for the next 3 years, and we think there'll be a massive surplus in 5 years, which obviously a hell of a lot of water goes under the bridge until that period actually gets there. But this one appears to be next year surplus, so not a lot to hide behind or get away from if it's not there. So it looks like it's on track for that. Is that your read as well?
Yes, exactly.
And how many years? 12, 15 years? How many years was it since the surplus, did you say?
15 since, yeah, it's been a long time coming.
Absolutely. Oh, well, we'll take a surplus and we'll see how we go. Aside from surplus next year, deficits the year after, what else is in it? What's some of the highlights for business, Charles? What have we picked the teeth out of on this one?
Yeah, unfortunately, it's not too much, but one of the most anticipated one. What's going to happen to the temporary full expensing? Well, as everyone knows, that ends at 30 June this year. But thereafter, for the next 1 year only, the instant asset write-off would go down to $20,000. So it's not all gone. You still have small business, still have the $20,000 limit. So your computers, your desk, your small equipment, that's all still going to be immediately deductible. But things like cars or large plants won't be, and also it won't be eligible for larger businesses.
Yeah, so most of I guess people on this podcast are probably not the $50 billion businesses out there. So most of our clients are small business, small to medium sized business, which is a great space to play in, I always think. But you're right. The vehicles, the large plant and equipment, the large machinery, whatever it is that you're buying, if it's here and ready before 30 June, temporary full expensing. If it's after 30 June, it's got to be a small business, and it's got to be which is under 50 mil. So you're still gonna. It 20? Was it 20 million turnover they're putting in that one?
I think it's a $10 million turnover this time.
10 million. Sorry, that's right. I knew they did tweak that a bit. There's so many different rules they have for what qualifies as a small business. So if it's a under $10 million turnover, and it's an asset under $20,000, then you can write it off next year when you buy it. Otherwise, you depreciate it as normal. So temporary full expensing, where you claim the whole lot up to 30 June. After that, the instant asset write-off, that term's back in favour again now, applies after that for small businesses under 10 million turnover, where the asset purchased is less than 20 grand. And it can be multiple assets, it's just per individual asset.
Correct, yeah. You can go out and buy 5 computers to deck out your office. That's all going to be deductible, even if the total bill is over 20. So as long as,
and that's only for the next year, isn't it? I guess that's to soften the blow in, and then is it 1,000 that defaults back to? What's the
Unfortunately, yes, the default is 1,000 for small businesses, which is not much. But yeah,
we'll see what the next budget does.
see what the next budget holds. So,
they've kicked it down for another year at least at 20 grand, which is better than nothing. So we get a little win out of that. I know you and I have talked about this many times on and off this podcast, but I guess, you know, EVs, do you want to run through that again? Just anyone new who hasn't listened to us, that it's a huge benefit.
Yeah, so what was listed in the budget paper was FBT exemption for plug-in hybrids will end on 1 April 25. Now, maybe deja vu out there, thinking I've heard this before. Yes, you have. That's always been part of the proposed legislation. And surprisingly, for one reason or another, the legislation that got passed didn't include this component. So now the government is formally putting this into the legislation. So once again, if you have a plug-in hybrid, if it's delivered, ready for use, and you enter into a lease agreement on or before 31 March 25, it's still eligible for the term of the lease. But if it's delivered or you enter into a arrangement after 1 April 25, you miss out. So after that date, it's going to be battery electrics only.
Yeah, and obviously this is plug-in hybrids, not your normal hybrids, has to be a plug-in hybrid. So huge benefits out there. Ring myself or Charles or someone if you want to know more about it, but sweet spot is a $65,000 plug-in hybrid or electric, and still very good, just up to under 85,000, 84.9, whatever it is. Still a good benefit there, but that sweet spot is a $65,000 EV. Full tax deduction if you purchase through your business, provided to an employee, no fringe benefits tax. It's a win-win-win. Get on board. We've gone on and on enough about that though, Charles. Let's so if anyone's not doing it, ring us now. But yeah, let's get on to the next topic. So GPs were a bit of a win out there, which is great for us because we've got a lot of medical clients. A little bit of a win, I should say.
Yeah, unfortunately, it's not as much as the industry bodies hope for, but a little bit's always better than nothing. Especially after the last couple of years coalition government of doing not much. Finally, GP and healthcare is back in favor. So a couple of interesting ones. Tripling of the bulk billing incentive. That's a great headline, but you got to read into the details, don't you?
It doesn't triple the amount you charge the patient, or you charge the government for the patient, I guess. It's the incentive is. Which what's that in real terms per consult?
Yeah, so it depends on how much incentive you get, based on whether you metro or regional or rural practice, but that you're looking at somewhere between maybe $12, $15 all the way up to maybe 20.
Yeah, so it's about
as
$6
an additional amount.
I think in regional, in metro, and maybe 9 in regional or something like that. So they've added another 12 or 18 say to the rate, which is still good, and that's for under 16 and
Commonwealth concession car holders. That's right. So it's not for the general public, but it's targeted at those most vulnerable and the doctors that look after those people.
So it's not going to save bulk billing, which is sort of being, the trend is away from bulk billing now, with particularly things like payroll tax really coming into play. It's practices just can't afford to stay as bulk billers. They've got to move to a mixed billing model really to be effective and to be able to run a business. This isn't going to save bulk billing, but it's going to help, at least, I think, help, as you said, the vulnerable, the young, and those sort of things that help maybe keep them on a bulk billing rate, and maybe the regular full tax paying adults are on the the normal mixed billing, or the standard billing where you're paying for that service when you go see the GP. So it's a little bit of a help, but it's not exactly not a savior that we might have hoped out there for that.
Exactly. It's not a silver bullet to the problem GPs are facing at the moment.
Yeah, that's right. There was a couple other little things for GPs you noted in there, things that were good. There was an extension to workforce incentive program. Is that right?
Yep. So the workforce incentive program, it's not many doctors actually making use of it, but it's a payment of up to $130,000 for encouraging the hiring of Indigenous health workers, allied health services, and related nurses, particularly targeted at those regional and outback communities where you get that full $130,000 incentive. So
And that's a program that's already out there. It's kind of an extension to that, isn't it? This.
correct. And if you haven't heard about it, if you're a practice that works with other allied health services, it's definitely worth exploring.
Yeah, and that's that workforce incentive program. And they announced some grants as well.
Yeah, there's going to be grants for GPs to assist with expanding community-based healthcare. So that's essentially to set up clinics and consultation rooms outside of the public hospitals in those regional and remote communities. And what the grant programs will involve at this stage, no idea. But at least the commitment's there. So
It's
there's
been announced
exactly
as
there's
a
a lot of money being put into this area. So watch this space.
So we just got to wait, I guess, till they announce more on that, don't we? But at the moment, it's been announced they're doing something. We just don't know the detail yet.
Yeah, and that's the federal government, and the state government always obviously have their own incentives as well.
And what about for employees? I guess for the individuals out there, there's the tax. Nothing changed with the tax, did it? That just continued on the way it was going to.
Yeah, so like it or not, stage 3 tax cut is here to stay. But given that it doesn't start until 1 July 24, the government still has one more year to potentially play around with it. But yeah, let's see how that goes.
At the moment, though, it's still status quo as it was. There's no real changes there.
There's no real change. It's still the same tax rate once we flick over to July. But yeah, there's going to be further tax cuts coming.
And for businesses, and there's more super to pay now. Super's ticking over because that's still in place and still increasing as for employers to pay and for employees to get.
Yeah. So right now it's 10.5%, everyone. So that's going to tick over to 11% from 1 July and 1 July 24. So in another year's time, it's going to tick over to 11.5 all the way up to 12% by 1 July 2025.
And that's the proposed end to that increase that was announced a while ago as well. I guess it's sort of it's been ticking up to get towards that 12%.
Yep.
And then, probably a few more budgets. We'll see what happens. But it's sort of up another 0.5% from 1 July. So
yeah,
keep that in mind. And most of the software manages that for people these days.
That's right. And yeah, just make sure if you ever do calculate it manually or you're working out your package for your employees, it's going to be 11% once we tick over to July.
Yep. And the other thing for super that I personally hate is this $3 million extra 15%. I get what they're doing, but I don't really like this. I was hoping personally there'd be something in this budget that would change. I guess the announcement that's been out there for a few months now about taxing an extra 15% if your individual super balance is above $3 million. I don't really like that as a concept anyway, but I hate the fact that it talks about it being on unrealized gains. They didn't change that.
Unfortunately not. So there's nothing announced, particularly in the budget on it. It's going to stay exactly as the government proposed back in February, but that's still pending draft legislation. So maybe
there's lots of lobbying, isn't there? Everyone's like, there's a lot of people lobbying to say that's a bit unfair. If you're going to bring this in, at least make it on realized gains, not unrealized.
Yeah, and that brings a whole range of issues with if it's on unrealized gains, and then the reason it's on unrealized gains is because they look at your total super balance from one year to another. So obviously, if you have assets that's grown in value, such as a property,
because you use a market value, not a historical cost.
Yeah. And what happens if it's grown in value, but you didn't have any cash to pay the tax? That's going to put a lot of people in a pinch. How are they forcing people to sell your assets just to pay the tax?
Particularly if you've got a high asset value with a low yield on it. All of a sudden, by the time you're paying out pensions and then paying unrealized tax on the growth of an asset that you haven't actually sold, to do that, you might actually have to sell that asset, which is, that can actually happen in this scenario. It's a bit ridiculous.
Yeah. So look, he's hoping that all the lobbying is make the government finally open their eyes. This doesn't make sense. I mean, arguably, whether people with $3 million in super should be tax additional, that's a personal opinion. But
Look,
the
and
whole unrealized gain, that just
yeah,
doesn't make sense.
as I said, I get their argument there. I see what they're trying to do there, and I don't like it, but I see what they're trying to do. But the whole, on unrealized gains is a bit ridiculous, really. If someone's got to sell an asset to pay the tax that was incurred because of the growth of that asset, well, that's just bad for the economy. Surely you can't, that just doesn't work. But anyway, that's where it is at the moment. Hopefully it gets a bit better. So key takeaways, what are we saying? It's a lackluster budget. We'll take a win that there's a small surplus forecast for this year, and it's not forecast for 5 years' time as it has been in the past. So we'll have a positive budget for the first time in 15 years, which is that, what is that, since GFC days? How long is that? No, is it that far back?
Since GFC, yeah.
Wow. So since GFC, we haven't had a positive budget. A surplus. Looks like we're getting one next year, and it's not an airy-fairy 15-year or 5-year away one. Looks like it's actually happening, but the downside is it's a spike, and it's likely to go back to a deficit in the years after that, predicted at the current rates. The businesses, try and get those assets in before 30 June if you can. If not, you're a small business, under 20 grand, still immediately deductible next year, and see what happens after that. And as we've mentioned many times, get on that EV train, if not from an environmental cause, surely from a tax benefit if it's bought by a business and provided to an employee. A little bit of detail to get right there, so don't go and just buy an EV and say that podcast said I could do it. Make sure you look into the detail. But if you're a business providing it to an employee or an associate of an employee, it's under that 85 grand, at the sweet spot of 65, it's an EV or a plug-in hybrid until April 25. I've said that enough times. Get on it, look at it, definitely worth doing. Charles, thank you very much. As always, our resident tax expert, really appreciate you joining us on this one. People can get in touch with you, just email, jump on the notes, find you, Ring Prosperity, jump on the website, Google us, you'll find us. Thanks everyone else for listening in. Please like and share, have a listen to our other podcasts, and get up those numbers for subscribing. Helps us so we know people are listening, and we can keep bringing you some good content. And apologies, it's been a little while since I've done the last one. I've been holding off waiting for this budget one and hoping we'd have some great news, but it's good enough. Thanks, Charles.
Good talking to you, Brendan.
Thanks for joining us for today's podcast. Hopefully you liked it, and if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.